Hello and welcome to What Goes Up, a weekly markets podcast. My name is Mike Regan. I'm a senior editor at Bloomberg.
I'm Valdana Hayek, a cross-asset reporter with Bloomberg.
And this week on the show, well, for the last few weeks, we've been focused on the train wreck in the crypto market. But there's been some pretty interesting developments in the traditional markets. The S&P 500 is up almost 13% from its bear market low in October. Interest rates have stopped their alarming surge higher, and there seems to be some cautious optimism that the worst of the inflation shock, not to mention the worst of the monetary policy tightening by the Federal Reserve, may be behind us. But is that really the right take right now? We'll talk to a global macro strategist who isn't quite convinced that inflation will fall completely back to earth anytime soon. But Valdana, before we get into that, I have to ask, have you seen the movie E.T.?
Of course.
Of course. Okay. I never know, as an 80s child, of course I had to see it, but so many 80s movies in retrospect are problematic now. The whole John Hughes series of movies have all been canceled, I think, by the younger generation.
Is E.T. problematic?
I don't know. That's what I don't, we were dumb in the 80s. We didn't know how problematic some of those movies were, but I guess that's a little teaser for my craziest thing in the market segment. I will say I'm also excited because this week's guest is a native French speaker, and I know you've been taking French lessons. So
yes, but I'm so bad. Don't call me out.
No, I want you to. You got to introduce him in French.
My French is horrible.
Horrible.
Très horrible. Oui.
What's that mean?
It's horrible. Obviously, hello. Horrible. Sorry. We have Vincent Deluard. I hope I did a really good job with that pronunciation. He's the director of global macro strategy at StoneX Financial. Vincent, welcome back to the show.
Pleasure to be back.
But maybe just to start out, so you just had this note out about the 7 deadly sins within the market, and you focus on tech specifically. And I'm thinking that actually is a really good view into how you're viewing the market and everything that's been going on, especially with some of the froth and speculation that we've seen over the last year. So maybe could you just go over how you're seeing things right now?
I think, this really reminds me of what happened in the summer when we also had a slightly positive inflation surprise and, all the strategies that had issued the peak inflation note in January, February, March, April, May. I got this one. And we had a same story, monster rally, a little bit of meme stock frenzy that was Bed Bath & Beyond back then. And then the view that, all right, just a couple more hikes and we'll be done and inflation's going to go away and it's time to go back in the hyper growth, highly valued unicorn that we're soaring in 2021. Again, we've seen the movie before. The main difference between this rally and this summer's is I do believe the path of disinflation is more valid now. I mean, I was probably one of the earliest strategists to come out with the view that we'd have 8-9% inflation in the US in 2022. And even I have to admit, yes, the economy is disinflating. Inflation is going to slow. Where I disagree with the market's view is that it's not going to slow back to, I think that if you look at a 1-year swap, we're probably looking at 2.9 by next year and then slowly going down to 2% after that. This is the part that I disagree with. I think we're going to look at a sustainably higher plateau of inflation at around 4.4 or 5%. And I would actually argue that's a good thing. And that's something that the market is still not pricing. So I do think that this will eventually end in tears, which is one of the reasons why I wrote this piece on the 7 deadly sins of Silicon Valley, to show that a lot of the behaviors that we had during the bubble years are still there. If anything, they're even more prevalent because the business is deteriorating. So a lot of the kind of funny accounting, paying employees in stock, overhiring, buying fake growth with ad, all that is still happening. Again, things never go in a straight line. And now it's kind of a time where the inflation worries have taken a step back. But I expect that they will eventually return.
Yeah, I was reading that 7 Deadly Sins note, Vincent, and let me just read out one line here because it really stuck with me. It's sort of towards the end of the note, kind of where your conclusion is. And you say the real Fed pivot will not be to cut rates in 2023, but to accept that a decade of 5% inflation is the least painful way to deleverage the economy, reduce inequalities, and restore sustainable growth. Wow, a decade of 5% inflation, or I guess to your point, maybe 4.5%, 5%. How does that play out in the markets and with the Fed? Right now the Fed funds futures are pricing in a terminal rate of right around 5%. Would this force the Fed even higher than that? And what's really driving that 5% for a decade inflation? Let's unpack this whole notion a little bit.
So, my view is that the true pivot of 2023 will not be so much the 2 or 3 rate cuts that the market currently has priced. So I do think we raise to 5%. And the pace of it ultimately is irrelevant, right? I mean, maybe these 75, bips monster hikes are overkill, right? So yeah, we can probably, afford to do a couple 50, even 25. But then I think rates do not drop after, mid 23, like the futures market has it, because inflation doesn't really drop. And the reason inflation doesn't drop is because by then inflation will be mostly about wages, and wages are, I would expect, will be around 4 or 5% by then. And I think we'll get to a point where the Fed will be in the position of George W. Bush after the invasion of Iraq. So you remember 2003, right? We go in looking for WMD. We don't find them. So the war is not going well. The occupation is not going well. So what do? We declare victory, right? And we never talk about it after again, right? This is when you had George W. on the aircraft carrier, the big sign, mission accomplished, right? If I were Jay Powell, I would do the exact same thing. I'd say, hey, mission accomplished, right? By May, I think we'll get to maybe 4 or 5% inflation. We'll have 4 or 5% Fed funds rate. So he's done it. He's the Volcker of our time. He's raised the Fed funds rate above the rate of inflation. Mission accomplished. Yeah. And then we should never talk again about what happened in 2020 or in 2021 when the Fed was buying, 35 billion of mortgage-backed securities when we had the massive housing bubble. That we can forget, just like we forgot about the WMDs.
They'll just get rid of that 2% target for now. Put that on hold.
That wouldn't be the worst thing in the world, and that's my point. I mean, if you look back at the history of the 2% target, it's a made-up number. It came, I think, from a press conference in New Zealand in the late 80s. They had a problem with inflation back then, and they had an economist on TV. And, he was asked, what does he think inflation is a good target for inflation? It's 2%. Why 2? Not too high, not too low. I mean, there's no scientific backing behind the 2%. If you look at the distribution of inflation and growth in the US, you'll actually notice that growth has been actually faster. Real economic growth has been faster when inflation has been in the 4 to 5% range. And you can very well make the case that what really hurts is when you have inflation at above 10% or really unpredictable inflation, because this is when agents can't plan for the future, investments don't get made, people hoard stuff. But as long as you have stable, somewhat moderate inflation, whether it's 2 or 4 or 5%, doesn't really change things. And I think that's the way most Americans also feel, like most Americans don't even know what the Fed does. They don't know about the 2% inflation. They just think of inflation as whatever happened in the past. So that's where the inflation expectation channel comes in. So a decade of 4 or 5% inflation is really not bad. I think we are in a period where we have a structurally tighter labor market, mostly because of demography, and also because we no longer have access to Mexican labor. A lot of the great moderation of the past 30 years was really the product of three forces. On the labor side, you had about 12 million Mexicans that crossed the border between basically the end of the tequila crisis, 1994, and 2007. And this flow has stopped and even reversed since COVID. So we no longer have cheap labor. On the good side, it was the China shock, right? We had this massive devaluation of the RMB in 1994, 1995 by about 70%. Add that the East Asian crisis, the entry of China in WTO, them subsidizing all sorts of production. So suddenly we have access to these supply chains, courtesy of Amazon and first Walmart, then Amazon. Obviously, if you if you follow what's been happening in China right now, this is maybe not where you want your supply chain. And this is not, if you just look at the demography of China, we'll have a massive crunch in the population of young workers in China because of the one-child policy. So we don't have cheap goods from China. We don't have cheap labor from Mexico. And then the last part was cheap capital. As the US had these massive deficits in the late 90s, what that meant is that you had all these countries that had a very large surplus: Europe, Germany, Japan, and then Saudi Arabia, commodity producing countries. And these surpluses would flow back into the US Treasury market via the capital account, because all these countries were trying to undercut their currencies so that they could get more exports. So for the US, it worked great, right? Because we basically send them treasuries, and then we got goods from them. So it was fantastic. That channel is also clogged now. Japan and Germany now have current account deficits. China is actually selling treasuries. So the three factors that boosted your inflation lower and that made it so easy for us to achieve that 2% inflation are gone. Cheap labor, cheap good, cheap capital. So it would be a lot harder to get down to 2%. I mean, I'm sure we could. Like if Powell wanted to be Volcker and he gets the Fed funds rate to 10%, we'd get to 2%. Why would you want to destroy the labor market when we are seeing the gap for minority wages actually closing? We're seeing young people do better finally. We are seeing asset prices go down, which is a good thing. You want people to be able to buy homes. You are seeing the real value of the debt being wiped out. I mean, inflation, if it doesn't go above 7-8%, is actually the medicine that we need. And we need to let that run out for a couple of years, and we'll be in a much better place. And by the way, it's not just me saying that. There was a very good op-ed, I think, in the FT about the same thing. So I think you'll see a lot more of that next year as central bankers realize that the cost of going back to 2% greatly exceed its benefit.
This scenario to me sounds, though, like a nightmare for profit margins and U.S. corporate profits, EPS for the S&P 500. I mean, is that the sort of bottom line conclusion from that type of outcome?
I think for now, we are still in the first order consequence of inflation, where inflation inflates everything, including profits, right? There's the money illusion in the terms of Keynes. Everybody thinks they're getting richer. And it's also because of how accounting works with inventories. Like if you value inventory at the lower pre-inflation costs, which actually shows very, very high profit. So I think that's one of the reasons why we saw profit margin spike in 2021. But as time passes, you're absolutely right. I mean, the cost of everything goes up, right? Your cost of energy goes up, the cost of labor is going up, wages are not slowing. Maybe they're hitting a plateau, but they're certainly not slowing in services. And then your supply chain is getting a lot more complex. If you can't produce in China, you cannot do the just in time anymore. So yes, margins would need to come down, but I mean, unless you're an owner of stock, I would argue that's a good thing. I mean, one of the issues we had for 40 years is this steady expansion of margins at the expense of labor. And that contributed to the concentration of wealth, 1% inequality issues. And I think the pendulum is finally swinging the other way in terms of sharing the value added by the economy was being captured by a handful of monopolies and their capital owners. And now the pendulum is switching back, and power is switching back towards labor. And I would argue that's a healthy thing after 40 years of concentration.
I like your caveat, though, unless you're an owner of stock, which might be one or two listeners out there.
I hope more than two. Three, hopefully.
Three.
Vincent, I'm wondering how likely it would be, for example, for the Fed to give up on its 2% inflation target, because would that not absolutely destroy their credibility?
Well, that's why they would have to be smart about it. And I think they can. There are many ways you can do it quietly without actually acknowledging it. And I do agree that, my whole plan only works if people believe the 2% target is still a reality, right? Because what we're talking about finally is ultimately financial repression, right? So you need to convince bondholder to keep buying bonds that are at low yield, and then you constantly kind of stealthily defaulting on them by this higher inflation. So I don't think Jay Powell is going to come out and say, guys, 5 is the new 2. But there are many ways you can do it. One way you could do it is called hedonic adjustment. So hedonic adjustment is something that the Fed has developed over time, to adjust for the fact that houses get bigger, cars get better, TVs get smaller and so larger, and that the quality of the product increases. So they only apply that to, I think, about 60% of the index right now. And it has a very strong deflationary impact, right? Because a 2000, for example, a phone, the price of an iPhone is, more than $1,000 now. But if you look in the CPI, you see it come down, because the Fed is, I think, correctly saying, well, an iPhone is incomparably better than the old Nokia that I'm sure Michael still uses.
That's such a good dig.
I did have one of them, yes.
He doesn't know how to open it, though. He doesn't know how to flip it open.
So the Fed has been hedonically adjusted certain time series and others not. For example, men's outerwear is hedonically adjusted, but our underwear is not. So, and I could go on with a list. Cars are hedonically adjusted, meaning when cars do get better, the price in the CPI is adjusted down, but motorcycle are not. So you have a lot of leeway, and this is like a really tiny technical thing. Like you don't even need to issue a press release. They could just do that. The BLS could just do that overnight. No one would notice. Another way you could kind of adjust the index in an inflationary way, in a deflationary way, so that you actually tolerate a higher level of inflation while still showing that you're technically meeting your 2% target, would be on the rents and the owner equivalent rent. So there's this huge debate right now about the way the Fed computes rent and especially OER. So shelter as a whole is about 30% of the CPI. You have 7% in rent and 22% owners equivalent rent. These are horrible statistical monsters that the BLS computes on really. And it's lagging a lot, right? That's what people are complaining about, is that the Fed is driving in the rearview mirror. The real estate market is already turning, has already turned if you look at Zillow's data. But because of the way it's computed, the Fed, the BLS computes rent inflation, that's going to keep increasing for the next 12 months. Well, maybe they could revise that. Say, you know what, we just wanted to make it better, closer to reality. And what that would do is that it would, it wouldn't change the reality, but it would make that what would have been 5% inflation becomes 2% inflation as the metric.
I'd love to hear the rationale for the underwear not being adjusted. There's just no innovation in underwear anymore, I guess. Maybe that's it. But so how does one position their investments for this type of environment you're describing? It sounds like you maybe take advantage of real yields if you're able to get some. To boil it down in the equity market, is it as simple as a growth versus value trade to stick with value over growth, that sort of thing?
You're generally correct. Short duration. If my scenario is correct, I would expect the yield curve to steepen quite aggressively next year. I find some of the short-term rates to be quite attractive. I mean, we now have positive real rates in the U.S. for the first time. Tips rate, 1.5, 1.6%. I actually, if you really want to get crazy with tips, go in Brazil. They're like 6 to 7% inflation-adjusted yield on short-term Brazilian bonds. In terms of equities, the portfolio that I've been recommending is what I call the Holy Trinity. And it's three equity sectors with very simple ETFs to trade: energy, healthcare, financials. That portfolio just equally split, one-third, is up 16% for the year. Your 60-40 portfolio is down 17%. I would stick with that, because what I love about that Holy Trinity portfolio is that it hedges against the three macro risks that we're facing. One, of course, is still inflation, in my opinion. You need your energy there. Energy is kind of your dark horse, scenario. Like, if we have something bad happening in Russia or China reopening suddenly, whatever, you'll see this energy go up. And that's how it worked in 2022. Energy was your risk-off asset. So energy hedges against inflation. Healthcare hedges against recessionary risk. Healthcare is actually the most defensive sector. It performs best in recession, better than utilities, especially now that, the problem is that we've had this recession with higher rates, right? So you don't want to go in your utilities or consumer staple. You want to go in a sector that actually has some potential for secular growth in addition to being defensive, which is what healthcare is. And then the third pillar of my Holy Trinity portfolio is financials, which I'm very excited going into 2023. If my scenario is correct, what we'll see is yield curves will steepen, and that's very good for banks. You'll have, about 1.5 trillion in reserves, excess reserve right now. I mean, they're just going to sitting at the Fed. They're going to connect 5% from zero. So that's about, I can't really do the math. I think that's about 150 billion subsidy just increase in pure profit just for the banks to have excess cash at the Fed. And then if I'm correct that the economy is actually doing quite well, like the labor market is very resilient, wages are still growing, people are not going to default. So I think the market is pricing a bit of a repeat of 2008. Credit card balances are going up, the mortgage, the housing market is imploding. I do not believe these things are going to happen in 2023. And as a result, I think banks are going to be the leader in my Holy Trinity portfolio in 2023.
How about a U.S. versus rest of the world in equities? It's some outperformance, global ex-U.S. Type of indexes these days. Is that going to continue?
I think when the market starts to understand that the Fed will pivot on inflation, that trend of outperformance of the U.S. will stop. It will be back to kind of the reflation trade, like what we saw in 2003, 2007, weak dollar. So you want to be long emerging market. I would say emerging markets outside of China, which have already done very well, by the way. The one issue with global investing is Europe. So, okay, forget about Europe, forget about Japan, forget about China. Now, the problem is this is really the big pieces of your, if you look at the MSCI index, these are the three big pieces. But once you've dropped the things that have gone down, you're left with actually pretty good stuff. So I call that the BIM chip. It's Brazil, Indonesia, Mexico, Chile, India, and Peru. These are 7 countries that are actually up on the year. And they are emerging markets. And these are not the kind of countries that you would expect to do well in a year when the Fed has tightened by about 400 basis points and the US dollar has, the dollar index has rallied by 20 points. These used to be thought as these kind of weak, vulnerable emerging markets, and they're actually doing very well. There is still a very strong case for global investing. You just don't want to do it for an index because the index is going to get you into places you don't necessarily want to be, which is mostly Europe or China's big tech, which, who knows what's going to happen there.
I do want to go back to your 7 deadly sins note and talk about number 1 and 6, because they're kind of two sides of the same coin. One being paying employees with stock instead of cash, and the other being what you call bad buybacks, buybacks that incinerate value for shareholders. You mentioned Meta in particular. Meta's buyback program incinerated $75 billion of shareholder wealth, or 30% of its current capitalization. So how do you see both of those issues playing out in the next few years? This massive buyback binge that the U.S. market's been on for, a decade or longer, and that notion of Silicon Valley using, stock as a currency to pay employees. Are both of them sort of jump the shark, if you will, or are both of those things kind of taboo going forward, do you think?
Well, first of all, I must log a complaint because you gave my craziest thing. So I'm going to have to think of something else on the fly. So in the case of Facebook, it's really two. So one is just you multiply the price at which you repurchase the shares by the quantity, and then you compare to where they are today. So that's about 35 billion lost right there. And the other one is by really saying that, if you do a buyback because you issued yourself some stocks, you're not really doing a buyback. You're just taking your shareholders' money and putting it in your pocket. So I added the stock-based compensation. It was about 35 billion in the past 5 years at Facebook. So half of that came from poorly timing the buyback and the stock price declining last year. And then half of that came from stock-based compensation, which, by the way, is the norm. Like another example would be Google. So in the past 3 years, Google has repurchased about 11% of its share outstanding, if you just look at the number, but the shares outstanding haven't changed. Why is that? Yeah. Because they've been issuing that to shareholders. So, that's long been going on, and I think investors used to have somewhat of a benign neglect on the practice when stock price is going up, because technically the buyback made money, right? I mean, if the stock price higher next year, you can say, oh, look, I bought back at 100, now it's 120. So it's been a wise use of shareholder money, even though really what it is just a trick to save cash And then, it's tax advantaged also a little bit. And then it makes you look better on certain metrics like free cash flow, operating cash flow. All that looks a lot better because you're paying, in most big tech companies, about half of your salary is paid in stock. So yeah, when the bubble was going, everybody was happy with that. And now I think, we're seeing the reality bite, right? I think the interest of the shareholders and that of workers are not aligned. And you see a lot of companies that, now that the stock price have gone down, they actually have to give out more stock, right? Because they want to give X dollars to their employee to be competitive with the Google, the Facebook, whatever. And now that, stock prices have dropped by 80%, they have to give 5 times as much stock as they used to. Yeah. So the amount of dilution that people are taking from this is enormous. And I do expect that, next year there will be somewhat of a shareholder revolt. Because not only is the company not performing, you're seeing this kind of slowdown in tech and social media, but on top of that, whatever earnings is left has diluted across, many more shares.
Well, so if, Vincent, if a company is actually reducing its number of shares outstanding with buybacks, is that, do they get sort of a pass on the deadly sin of bad buybacks?
Yeah, for Apple would be a case where you have about a 1-to-1 ratio between buyback and float shrink. I think, by the way, that's an insane stat. I think Apple repurchased more than 500 billion in stock since they started the buyback. I mean, 500 billion. Can you imagine this? I mean, this would have been the largest company in the S&P 500 just a couple of years ago. Yeah, I mean, you have all these. I don't necessarily want to go in the the buyback debate. Some people hate them. I mean, if you make a lot of money, the way Apple does, if you don't return cash to shareholder, you'll end up as, having more and more equity and less debt, right? And you may want to keep your financial structure the same, and a buyback is a way to do that. And it's a way to do that in a way that's more flexible than a dividend, right? Because if you cut the dividend, people are going to get mad at you. Buyback is a bit different. But so I'm not like philosophically against the use of buybacks. I'm philosophically against the use of buybacks if it's a trick to hide lavish stock option packages to employees that basically just, use the company as a stock printing machine and run away the cash. But in theory, there's nothing wrong with the buybacks. What I will say, however, is that the market has become very reliant on these buybacks. So over the past year, we had about $1 trillion in buyback in the past year. That is a lot. That is a lot. That is a record. And I doubt that this is going to keep happening because, it's a lot harder to issue debt. You have a lot more to pay on debt. A lot of companies are conserving cash. We also have a buyback tax that's coming as part of the Inflation Reduction Act. There's a 1% tax on your buyback. So one of my concerns is that we could see a fall in buybacks next year, also because the big tech companies are not going to get away with these fake buybacks anymore. And maybe we could see it drop from 1 trillion to 500 billion. And then the question is, what replaced that 500 billion equity demand? I don't have a good answer for that.
I think Goldman is estimating something like 800 billion. But I want to ask about one of your other sins, which is overhiring. And obviously, we've seen a bunch of tech layoffs, obviously a ton of crypto layoffs. There's seemingly a new company in crypto announcing layoffs just about every day. So I'm just wondering if that's sort of representative of what you think potentially we could be seeing going forward in the labor market, because we're not seeing it yet, right?
Yes, that's a good question. So I want to put the tech layoffs in perspective. And of course, we all have friends. I mean, I live in San Francisco, so I all have friends who are either concerned with it or so it's unfortunate when that happens. But if you look at the MAGA stock, the big tech stocks, headcount doubled since pre-COVID. You had this insane hiring boom in 2020, 2021. I mean, I have friends who are like, who told me I couldn't even at Google, I couldn't do my job because I spend my days just interviewing candidates. And what the pandemic did, it created this once in a lifetime flood of demand for device, online entertainment, cloud services, and a lot of big tech firms thought that this was going to be permanent. In some way, that kind of reminded me of what happened in 06 or 05, 06 with the big banks, when that's when I started. And I remember you had these lavish cocktail parties at US universities where, the class of 2027 was twice the class of 2026 for the new analysts. And of course, the hangover lasted for 10 years in the banks. So I think what we're seeing in tech is very similar. And it's unfortunately just the tip of the iceberg. So it doubles in 2019, right? So we could technically all have the Twitter treatment of firing 50% of the workforce, and we'd only be back by 3 years. Now, as far as what that means for the labor market, I really would not emphasize the relevance of this tech layoff for the economy. I mean, tech is still a very small sector, and it's not a very worker-intensive sector. I mean, the bulk of your workers in the US are cashiers, waiters, factory workers. And this is where the inflation problem is. Like if you look at the job openings data or the wage growth data, you'll see that the pressure is at the low end. It's very hard to get a roofer. It's very hard to get a waiter that's going to stick around for more than a month. It's very, very hard to get someone to work in the kitchen. And I don't really see how, laying off somewhat overpaid, 25-year-old product managers at LinkedIn, who, used to go to the office to do yoga and eat avocado toast, is really going to address the...
Don't shame the millennials.
I was shaming the Zoomers here.
Hey, I eat avocado toast, and let's not get into what generation I am. But Vincent, to your point on all that, every time that JOLTS job openings number comes out, my mind kind of boggles at the fact that there's still this 10 million job openings. Mm-hmm. How big of a deal is that? Are they going to just sort of evaporate? Or are they just going to stay there and keep this unemployment rate low, regardless of how many Silicon Valley layoffs we've seen? To your point, maybe a 25-year-old avocado toast eater at LinkedIn doesn't want to go be a waiter, but at some point, maybe they won't have a choice.
We'll see. Yeah, there's been some debate about the quality of that JOLT data, because if you do, I mean, where we are is absurd, right? I mean, if you plot the series over time, I mean, at the prior peaks in 07, in 2018, we had about 5 million job openings, and now we're at 10.
And basically because it's free now to post a job opening somewhere.
That is one argument that people have made. Also because of the work from home movement, you no longer, if you were Google, you only advertise in Mountain View or Silicon Valley, right? But now since your labor pool is potentially can be spread across the country or even the world, maybe you're going to have 10 job postings for a single position. It's possible that there is some of that, but to me, the real labor shortage, and I think any labor economist would agree, is not product manager at LinkedIn or Facebook or one more data scientist at Twitter. It's kind of the old economy, boring job that, I'm going back to retail, cashiers, waiters. And these are not the kind of jobs that are posted on LinkedIn that come with a sign-in bonus. So I actually do believe that the labor market is going to remain tight. And I'm not sure that we want to destroy it. I mean, sure, like I said, if we get the Fed funds rate at 10%, we'll solve it. Wow, we'll have, 10% unemployment rate. We'll have food riots, and we'll undo the past few years where we've actually seen gains for young workers, for minority workers, for workers paid hourly, for workers without college degrees. I mean, this is what we wanted, right? For 10 years, every Davos summit was about, how do we solve the inequality, because they care, right? Now we have it. So why would we want to destroy that, especially as inflation is slowing naturally Like even like why is inflation slowing? Because of commodities and used cars and plane tickets. So just because of its own inertia, inflation is going to slow. So why would you want to kill the labor market on top of that?
And Vincent, I want to go back to a point you made about China, because you mentioned China, but we haven't really talked about it and how what your views are on what's going on there or what we can expect from China and any potential reopening they have. I'm wondering how hard it is to have conviction in your views right now when China is such a big part of the equation and we don't quite know what's going to be happening with China.
That is an excellent point. And that's difficult, especially in commodity sectors, right? Where, it's copper, iron ore. I mean, China famously consumes half of everything. And the fact that, Chinese policy is so erratic right now makes it very hard to plan. So in the short term, unfortunately, I think there is no good answer other than, I would argue, kind of avoiding it and focusing on non-China EM, the BIMSTEC countries I mentioned. In the long term, I actually do think that what we're seeing is a trap for the deflationist crowd, or the peak inflation crowd, right? Because what's going on really is, China is locking down much harder than people thought. And as a result, that gets all your iron ore, your copper, your steel, all the commodity prices are falling off a cliff. And that makes you feel like, oh, it's working. Inflation is slowing down. The Fed is solving the problem. No, it's not. The real problem, and I would argue it's not a problem, but it's a problem if you want to go back to 2%. The problem in the US is wages in the labor market. But because of the China situation, we are seeing this air pocket that inflation is indeed dropping very rapidly. But that's temporary, right? I mean, at some point we know that China is going to reopen. So whatever we are getting now in terms of deflation will be tomorrow's inflation. And then also what the China situation does is that it further messes up your supply chains. It made the global economy less efficient. And at the end of the day, that is the long-term problem with inflation is, if we cannot, manufacture everything in China anymore and have this super efficient supply chain with zero inventory, we'll have to pay more for stuff. So the more messed up China is, the more inflation we have here eventually. So I think what China is doing is laying out almost a perfect trap for the see, always told you that inflation was going to peak crowd, and we'll get the second effect consequences in 2023.
Vincent Deluard of StoneX, always a real treat to get your views. And I apologize that I front ran your craziest thing there. That was bad etiquette on my part. I do feel bad. Now, Vildana, trivia question about E.T. Do you know the name of the actor who actually played E.T.?
No, I have no clue.
Do you think there was an actor inside the suit playing E.T.?
I don't know how they did it.
I didn't either. I
guess,
never thought
right?
about it. It was not a small little skinny-necked actor inside of it. It was actually a mechatronic model. It's really cool. I wish, on the podcast I can't really describe it, but it's this sort of
E.T. for sale?
Bundle of cables and circuits and metal, and it is for sale.
Wow.
The mechatronic model used is going up for auction at Julian's Auction. Let me tell you a little bit about it before the bidding starts in our Prices Precise segment, which, Vincent, by the way, I regret to inform you, you are a contestant on our game show, the Prices Precise. It's made from Dura aluminum, which I'm not even sure what that is. It has 85 points of movement. It can blink, make abdomen rotations. It's enabled through both electric and mechanical cables. It takes 12 people, by the way, to operate the ET model. One disappointing hole in the story from ArtNet, where I got this, is they don't tell you if it's still operating the way it should. I assume it is. I assume it probably is. I don't know. These things were built to last. There's, it looks like it is anyway. However, this ET mechatronic model is considered his masterpiece. So the question for you two is, what do you think the auction house expects to get the winning bid for the mechatronic model of ET? You ready to bid?
I'm going to go with $3.8 million.
3.8 million.
Vincent is making big eyes.
I'm going to say $1 above. What do you had? 3.8? 3.8 seems like a lot, honestly. You know what? I'm gonna.
It's ET.
No. The Fed hiked rates. Like with the economies, like no. I'm gonna go low. I'm gonna go at 1.2 million.
1.2 million. I think given the rules of the game, unfortunately, Vincent won, Vildana.
What?
You were closer, but Vincent wins given you bogeyed.
How much
you went
is
over 3 million is what they're expecting.
Wow.
3 million. I can kind of see that for, a
Me
movie
too. It's
tech
ET.
buff, I can kind of see it. Yeah. So.
Okay, should I go? Mine is very good too, but I
Let's
love
hear
ET,
it.
so that was really good. Okay. And we have to talk about crypto. What's a week this year without crypto? So
Certainly.
this story is from the FT. It's about all the lavish spending that happened at FTX. First, the story says Amazon didn't deliver to the Bahamas, so FTX actually hired a private air carrier to fly in orders.
Oh my god.
They spent $300 million in real estate in the Bahamas. And the FT says most of those purchases related to homes and vacation properties used by senior executives. Then they had round-the-clock catering. They had free groceries, a barbershop pop-up, bi-weekly massages. They had a full suite of cars and gas covered for all employees, and also unlimited full expense-covered trips to any office globally. That sounds cool. Staff at FTX US, so that's the US arm of FTX. Separate arm, but they were allowed $200 a day in DoorDash delivery credits.
That's the one that stood out to me. 200 in DoorDash.
Who could spend 200? Like I would spend $30. And then the last one is Alameda Research owed Margaritaville in Nassau $55,319. Open tab.
Margaritaville, the Jimmy Buffett restaurant, Margaritaville?
Yes, exactly. Yep.
My goodness. But they were told to be good tippers because of the whole altruism thing. So there's that. I don't know. They're going to miss them down there in the Bahamas. The bartenders of the Bahamas and the waiters and waitresses might be the hardest hit victims of this. Unbelievable. Vincent, have you ever spent $200 a day on DoorDash?
He's shaking his head no. Yeah, speechless. That's good, right?
How's it going? That was a good stuff. Hey, they, I don't know. I don't know what to say anymore about FTX. The minute you think you've heard it all, it just keeps getting stranger and stranger.
Well, I'm going to add my own strange thing to that. And again, apologies, I'm going on the fly here. So this is more of a question than a crazy thing. I saw on Twitter, and apparently there's already a movie. Of course, there's always a movie being read, like Netflix now will come out with movies before the event actually takes place. And one thing that really puzzled me was they had Ryan Gosling as SBF. Have you guys seen that? And was that like a fake, or who thought that would be a good idea?
I did not see Ryan Gosling being
That's
starred
pretty funny.
as SBF. Is there truth to this rumor?
Maybe we should ask the audience.
Twitter, so you never know.
I mean, they did give him like a weird wig, and they tried their best to hide how attractive he is, but we're still very far from the original cast.
I anxiously await that movie, regardless of who it is. What was that guy? Seth Rogen, I think. I could play him, right? With the curly hair.
Yeah, Seth Rogen would be a much better pick.
Yeah. They'll have to.
But if I may use this like as an opportunity to kind of make a broader social case, I think if you look at the list of the top grossing movies or documentaries of the past couple years, it's all about fraud. You got your Tinder swindler, your Anna,
Tinder swindler is so good.
It's
so good.
Theranos, of course, is going to be the crypto stuff, and I think it says something about the time we live in compared to when I was growing up. It's your Rambos and Rockies, kind of manly macho man, and now we have this really weird subgenre that is highly popular of Fire Festival, like documentaries about epic frauds, and I think it speaks to the zeitgeist of our time.
That's a pretty good observation, actually. Someone, Vildana, could make a story out of that, perhaps.
I could, perhaps. This is a good idea. But no, it's true. When you log into Netflix, it tells you what's trending on Netflix. And it is always Tinder Swindler, a couple of like those Love is Blind shows, which I'm going to admit, I love those shows. They're so fun to watch. And then, the rest is like stuff that's happened, that's real life stories where somebody got swindled out of a lot of money.
Well, there you go. Oh, the Hollywood. Who were the two that were breaking in all the Hollywood stars? That was a big one too. What was the name of that?
I don't remember.
They became famous for breaking into all the Hollywood. I don't know. I'll by next
Hollywood
week.
Homes?
Was that the name of it?
Bling Ring. Our producer Stacy says it's Bling Ring.
Thank you, Stacy. Bling Ring. They would go on social media, and if some A-list celebrity was like, looking forward to a vacation in Hawaii, they'd be like, all right. They'd head to their house and rip them off.
Oh.
Not quite fraud, but
smart criminals.
Point.
Yeah.
That's a good observation. Vincent Deluard, Director of Global Macro Strategy at StoneX. Always fascinating to hear how you're thinking about markets and movies, too. So we appreciate it and hope we can bring you back again someday soon.
Yeah, thank you, Vincent.
What Goes Up will be back next week. Until then, you can find us on the Bloomberg Terminal, website, and app, or wherever you get your podcasts. We'd love it if you took the time to rate and review the show on Apple Podcasts so more listeners can find us. And you can find us on Twitter. Follow me at Reganonymous. Vildana Heinrich is at Vildana Heinrich. You can also follow Bloomberg Podcasts at Podcasts. What Goes Up is produced by Stacey Wong. Thanks for listening. See you next time.